Sometime in early 2026, a single ounce of gold crossed $5,000. 2 years earlier, that same ounce traded near $2,000. Nothing about the metal itself had changed. It was not rarer. Mines pulled a record 3,600 tons out of the ground in 2025, more than any year in history. No new use had been invented for it, and yet the price had more than doubled, setting a new all-time high roughly once a week for over a year. That is a strange thing for a 5,000-year-old object to do. Gold is not a startup. It does not release quarterly earnings. It does not ship a better product. When the price of a company doubles, you can usually point to something it built. When the price of gold doubles, the metal is telling you something about everything around it, about currencies, about trust, about who is quietly moving money out of one system and into another. So the real question is not why gold went up. The question is what gold going up is measuring. Because a rising gold price is never really about gold. It is a thermometer pressed against the global financial system. And in the last 4 years, that thermometer has been climbing fast. Follow the money behind this rally, and you do not find retail investors chasing a meme. You find central banks, the same institutions that print the currencies gold is priced in, buying the metal by the 1,000-tonne. You find a war that froze $300 billion in a single week. You find the dollar's grip on the world slowly loosening, one reserve at a time. This is the story of how a metal with no yield, no cash flow, and no CEO became one of the most important signals in global finance. To understand why gold got so expensive, you have to understand what money stopped being able to promise. Gold is, physically, a mediocre material. It is too soft to build with, too heavy to carry in quantity, and useless for almost everything the modern economy actually needs. Yet, nearly every civilization that discovered it independently decided the same thing. This is money. Egypt, Rome, Imperial China, the Inca, none of them shared a market, and all of them landed on gold. The reason is boring, and that is exactly the point. Gold does not rust, tarnish, or decay. An ounce buried for 2,000 years comes out identical to an ounce mined yesterday. It cannot be created by decree, only dug out of the earth at enormous cost. Global supply grows by only 1 or 2% a year, no matter how badly anyone wants more. Money made of gold could not be quietly multiplied by whoever controlled the mint. That last property is the one that matters for this story. For most of human history, the constraint on money was physical. A king could debase his coins by mixing in cheaper metal, but people noticed and the coins lost value. Gold imposed a discipline that paper never could, because you cannot print a mineral. For centuries, the world's major currencies were simply claims on gold. A dollar, a pound, a franc, each was a promise that you could walk into a bank and exchange the paper for a fixed weight of metal. The paper was convenient. The gold behind it was the actual money. Then, in the 20th century, that link was severed, deliberately, and in stages. Understanding how the world unhooked its money from gold is the key to understanding why, decades later, the money is quietly hooking itself back on. On August 15, 1971, President Richard Nixon went on television and told Americans he was protecting the dollar. What he actually announced was the end of gold-backed money. Foreign governments could no longer exchange their dollars for US gold at the fixed rate of $35 an ounce. The window, as it was called, was closed. It never reopened. The system he ended had a name: Bretton Woods, designed in 1944 to rebuild the post-war world around a dollar that was itself anchored to gold. For a generation, it worked. But the United States had printed more dollars than it held gold to redeem, and foreign governments, led by France, began demanding metal for their paper. The vault was draining. Nixon chose the dollar over the gold. The moment the anchor was cut, gold was free to float. And it did. Within a decade, an ounce that had been fixed at $35 traded above $800. That was not gold becoming more valuable. That was the dollar revealing how much value it had quietly lost, once nothing physical held it in place. This is the mechanism at the heart of every gold story since. In a world without a gold standard, currencies are backed by nothing but confidence. The belief that the issuing government will not print too much and will honor its debts. When that confidence is high, gold sits quietly. When that confidence cracks, gold moves. For 30 years after Nixon, confidence mostly held. Inflation was tamed, the dollar reigned, and gold drifted, unloved, treated as a relic. Central banks were net sellers, dumping the metal as a barbarous holdover. That consensus would last until the moment the printing presses came back on, in the crisis of 2008. To understand the last 4 years, you need one concept. Gold is the anti-dollar. It pays no interest and generates no earnings. Holding it costs you the return you could have earned elsewhere. So the price of gold is really a running referendum on the alternatives, on the dollar, on interest rates, and on how much you trust paper promises to hold their value. When real interest rates are high, when a government bond pays you meaningfully more than inflation, gold looks weak. Why hold an inert metal that yields nothing when a treasury bond pays you to wait? But when real rates fall or turn negative, the calculation flips. A bond that pays 2% while prices rise 4% is quietly losing you money. Suddenly, the metal that yields nothing yields more than the bond that yields something. That is why gold and confidence move in opposite directions. Gold does not need to promise a return. It only needs the alternatives to look worse. Every time a central bank cuts rates, prints money, or lets inflation run, it lowers the bar gold has to clear. The metal wins by default. There's a second force, slower and deeper than interest rates: the fear that the currency itself is not safe. A bond pays interest, but a bond is still a promise from a government. If you doubt the government or fear it might freeze your account, the interest stops mattering. You want an asset that is nobody's liability. Gold is the only major financial asset that is not simultaneously someone else's debt. Hold those two levers in your mind: the cost of holding gold, set by real interest rates, and the trust in paper, set by geopolitics. For most of the 2010s, the first lever dominated. After 2022, the second one took over. And that is when the price left orbit. When Lehman Brothers collapsed in September 2008, the world's central banks did something they had never done at that scale. To stop the financial system from freezing, they created money, trillions of it, and used it to buy bonds. The technical name was quantitative easing. In plain terms, the presses came back on, and the discipline gold used to impose was gone. Gold understood immediately. From under $1,000 an ounce in 2008, it climbed past $1,900 by 2011, nearly doubling as balance sheets ballooned. Investors were not betting gold had become useful. They were betting that money conjured from nothing would eventually be worth less, and they wanted an asset that could not be conjured. But then something confusing happened. The feared inflation did not arrive, not right away. The new money mostly pooled in the financial system rather than in consumer prices. By 2013, gold fell back, and for the better part of a decade, it went sideways, dismissed once again. The lesson markets took was that central banks could print without consequence. That lesson would prove premature. What the 2000s quietly established was a new normal. Crisis met with creation. Every shock, European debt, Brexit, the pandemic, was answered by lowering rates and expanding balance sheets. The tool that was supposed to be emergency only became routine. Each round eroded, a little more, the idea that paper money was inherently scarce. Then came 2020. The pandemic triggered the largest monetary expansion in peacetime history, and this time, the inflation did arrive. Prices surged worldwide. Gold ticked up, but stayed oddly contained, because central banks began raising rates hard to fight the inflation, and high rates are gold's enemy. The metal waited. It was waiting for the moment when the second lever, trust, would break. That moment came in February 2022. When Russia invaded Ukraine in February 2022, the Western response was not only military aid, it was financial. Within days, the United States and its allies froze roughly $300 billion of Russia's foreign reserves, money the Russian central bank had parked in dollars and euros, held in Western banks. With a keystroke, a sovereign nation's savings became unreachable. For the Kremlin, it was a catastrophe. But for every other central bank on Earth, it was a lesson. And the lesson had nothing to do with Russia. It was this: the dollars and euros you hold as reserves are not truly yours. They are entries in someone else's ledger, and that someone can switch them off. Reserves you thought were the safest asset in the world turned out to be safe only as long as you stayed on the right side of Washington. Ask yourself what a central banker in Beijing, Riyadh, or New Delhi concluded that week. Their reserves were built on the same foundation Russia's had been. The interest those dollars paid suddenly looked irrelevant against the risk that, in some future dispute, the account could simply be frozen. The promise of paper had a hidden clause, and everyone had just seen it enforced. There is exactly one major reserve asset that cannot be frozen by a foreign government: physical gold, sitting in your own vaults on your own soil. It pays no interest, it is nobody's liability, and crucially, it is nobody's to switch off. In a single week, gold's greatest weakness, that it yields nothing, was outweighed by its greatest strength, that it answers to no one. This is the hinge of the entire story. The 2022 freeze did not just anger Russia. It quietly changed the risk calculation of every institution that holds national savings. And what those institutions did next, in the vaults and in the markets, is why gold got so expensive. For most of the modern era, central banks were sellers of gold. Through the 1990s and 2000s, they steadily unloaded it, treating the metal as dead weight. That reversed after 2010, but the change was gradual until it wasn't. In 2022, the year of the freeze, central banks bought a net 1,136 tons of gold, the highest annual total since records began in 1950. That number is easy to skim past, so anchor it. Through the 2000s and 10s, central banks added an average of about 470 tons a year. After 2022, the pace more than doubled and stayed there. Over 1,000 tons in 2022, again in 2023, and again in 2024. 3 consecutive years of buying at a rate the world had not seen in the lifetime of anyone reading a modern balance sheet. This is what makes the current rally different from every gold bubble before it. Past surges were driven by investors, traders, and funds chasing a trend, prone to panic and reversal. This one is led by the most price-insensitive buyers on Earth, institutions that are not trying to get rich, but trying to get safe. A central bank does not sell on a dip. It accumulates for decades. And these buyers create a floor that ordinary demand never could. When a fund buys gold, it will eventually sell to lock in a profit. When a central bank buys gold, it is rebuilding a strategic reserve it intends to hold for a generation. That metal leaves the market and does not come back. Every ton a central bank vaults is a ton permanently removed from the tradable supply. So who exactly are these buyers? And why are some of them so determined to keep their purchases quiet? Follow the tonnage and it points again and again toward the same set of capitals. The ones with the most reason to distrust a dollar they cannot control. Start with Poland. In 2025 alone, the National Bank of Poland added 102 tons of gold, lifting its holdings to 550 tons, and making it the single largest buyer of the year. A country on NATO's eastern edge, watching a war next door, decided its safest reserve was metal in its own vaults. 22 central banks increased their gold reserves that year. Poland led them all. Then there is China, the buyer everyone watches and no one can fully measure. The People's Bank of China reports its gold purchases selectively, resuming and pausing its official buying in ways that analysts believe understate the true scale. China is simultaneously the world's largest gold miner and one of its largest importers, and almost none of that metal leaves the country. For a nation holding trillions in dollar assets, gold is the one reserve Washington cannot touch. The pattern is not random. Research from the European Central Bank found that the countries increasing their gold share fastest are precisely those geopolitically closest to China and Russia, the nations with the most exposure to a dollar system they do not control. Gold buying, in other words, has become a map of who is quietly hedging against the West. Even the total buying, slowing down, tells the story. In 2025, central bank purchases eased to roughly 860 tons, down from the frenzied peak, yet still the 4th largest annual total ever recorded. What looked like a temporary panic in 2022 has settled into a permanent policy. The elevated pace is not the emergency anymore. It is the new baseline. This is the demand engine beneath the price. Not a mania, but a migration, a slow, deliberate rotation of national savings out of paper and into metal. And it feeds into a shift far larger than gold itself, the gradual erosion of the dollar's 40-year grip on the world's reserves. For 80 years, the US dollar has been the water the global economy swims in. Oil is priced in dollars. Debt is issued in dollars. When any two countries that distrust each other need to trade, they settle in dollars. In 1999, the dollar made up roughly 71% of the world's official currency reserves. It was not just a currency, it was the system. That share has been slipping. By the middle of 2025, the dollar's portion of global reserves had fallen to about 56%, a 30-year low. The dollar is not collapsing, and no rival currency is replacing it. What is happening is quieter, and, for the dollar, arguably more corrosive. Central banks are not moving into the euro or the yuan. They are moving into gold.
This is the part that unsettles policymakers.
A shift from dollars to euros would just be reshuffling paper. One government's promise for another's. But a shift from dollars to gold is a vote against paper itself. It says, we would rather hold an inert metal than any government's IOU, including our own allies. It is a hedge not against a currency, but against the trustworthiness of currencies in general.
The scale is now impossible to dismiss. By the end of 2024, gold made up about 20% of global official reserves. The euro, the world's second most used currency, made up 16%. For the first time in decades, central banks collectively held more of their reserves in a metal than in the currency of the world's largest trading bloc. The relic had overtaken the modern money.
The dollar still leads, and by a wide margin. But the direction of travel is clear. And it has been clear since the week Russia's reserves were frozen. Gold's price is not just rising, it is absorbing the trust that is slowly leaking out of the paper system. And it is not only governments doing the leaking. The public has joined in. Central banks built the floor. Then, in 2025, everyone else piled on top. Global holdings in gold-backed exchange-traded funds, the vehicles ordinary investors use to own gold without touching a bar, grew by roughly 800 tons, the second strongest year on record. In a single quarter, these funds pulled in $24 billion, an all-time high. What made 2025 remarkable was that both halves of the world bought at once. Western investors, historically the swing buyers of gold, poured back in as they watched inflation linger and rates start to fall. And in the East, Chinese demand exploded. Total Chinese gold demand hit 1,003 tons, the highest since 2021, while assets in the country's gold ETFs jumped by 243% in a single year. East and West, institutions and households, all reaching for the same metal in the same window. This is what turns a steady climb into a vertical one. Central bank buying is patient and price insensitive. It sets a rising floor. Investor buying is emotional and momentum driven. It sets the spikes. When a private investor sees gold making new highs week after week, the fear of missing out becomes its own fuel. Buying drives the price up. The rising price attracts more buyers, and the loop tightens. Notice the psychology underneath. A Chinese household moving savings into gold is doing, in miniature, exactly what the central bank is doing in bulk, seeking an asset that no policy can quietly erode and no institution can freeze. The distrust that started in sovereign vaults had spread to living rooms. The signal had gone retail. But a surge in demand only sends prices vertical if supply cannot answer it. If miners could simply dig faster to meet the buying, the price would cool. Here's the trap the gold market is built on, and the reason this rally has so little to push back against it. The supply of gold is almost incapable of responding to its own price. In any normal market, a soaring price is its own cure. High prices lure new production, supply floods in, and the price settles. Gold breaks this rule, and understanding why is essential to understanding why the price kept running. Even in a record year, the world mined about 3,670 tons in 2025, a new all-time high and a rounding error against demand. The problem is time. A new gold mine is not a factor you switch on. From discovery to first production, a major deposit routinely takes 10 to 20 years through exploration, permitting, financing, and construction. The gold selling at record prices today was committed to a decade or more ago, when prices were a fraction of what they are now. Today's price cannot summon today's supply. It can only, maybe, summon supply for the 2040s. There is a deeper worry haunting the industry, captured in a phrase geologists use quietly: peak gold. The easy, high-grade deposits near the surface have largely been found and dug. What remains is deeper, lower grade, and more expensive. More rock crushed for less metal. Annual production has flattened despite record prices, which is exactly what you would expect if the planet's most accessible gold is already gone.
Now combine the two halves of the market. On the demand side, central banks vaulting metal for a generation, plus investors piling in east and west. On the supply side, production that grows 1 or 2% a year at best, no matter how high the price climbs. Demand that responds instantly, meeting supply that responds in decades. The pressure has almost nowhere to go, except into the price. That imbalance is the mechanical engine of the rally. But mechanics alone do not explain why this particular moment tipped over. For that, you have to return to the two levers, real interest rates and geopolitical trust, and watch what happened when both of them broke gold's way at the same time. Step back far enough, and the gold rally stops looking like a market event and starts looking like a historical one. Consider a single fact from the European Central Bank. At the middle of the 1960s, under the old gold standard, the world's central banks together held roughly 38,000 tons of gold. By 2024, after decades of treating the metal as obsolete, they held about 36,000 tons, and climbing back toward that Bretton Woods peak. Think about what that means. For 50 years, the story of official money was a story of leaving gold behind, cutting the anchor in 1971, selling the reserves in the 1990s, trusting paper to hold its value. That entire arc is now reversing. The institutions that spent 2 generations moving away from gold are moving back toward it, ton by ton, until their vaults look like they did in the era of Bretton Woods. This is why the ECB itself flagged the moment gold overtook the euro as a reserve asset. When the central bank of the euro publicly notes that the world trusts a lump of metal more than the currency it prints, that is not a market curiosity. It is an institution acknowledging a shift in the ground beneath it. The reserve system is being quietly reordered, and gold is the winner. The drivers, when central banks are surveyed, are strikingly consistent. 2/3 say they hold gold for diversification. 2/5, a share that has climbed sharply since 2022, say they hold it as protection against geopolitical risk. That second number is the freeze of Russia's reserves showing up in a survey. It is fear, quantified, and filed in an official report. So the record price is not an anomaly to be explained away. It is the market pricing in a structural change. A world where the guardians of national wealth trust paper less and metal more than they have in half a century. The question that leaves us with is uncomfortable, and it is the one the price is really asking. Put the pieces together and the mechanism becomes clear. Gold's price is set by 2 forces, and after 2022, both pushed the same way. The first is real interest rates. As inflation lingered and central banks began cutting rates, the return on holding cash and bonds shrank, and the cost of holding gold, the yield you give up, shrank with it. The metal's greatest disadvantage quietly faded. The second force is trust, and it broke gold's way even harder. The freezing of Russia's reserves, the slow erosion of the dollar's share, the spreading sense that any paper asset carries a hidden political risk, all of it drove buyers toward the one asset that is nobody's liability. When both levers move together, gold does not drift, it launches. That is why an ounce roughly doubled in the span that it did. But here is the crucial reframing. Gold did not become worth $5,000. The dollar, and every currency beside it, became worth less gold. The number on the chart is measured in currencies, and it is those currencies the chart is quietly indicting. A rising gold price is a falling confidence reading, printed in reverse. This is why professionals treat gold as a signal, not just an investment. It is the market's aggregated verdict on the health of the monetary system, a distributed vote cast by every central bank and investor choosing metal over paper. When that vote swings this hard, this fast, it is measuring something real, a loss of faith that no single government can talk away. And the vote is still being counted. As long as real rates stay low and geopolitical trust stays fractured, the 2 forces that lifted gold remain in place. The rally is not a bubble in search of a pin. It is a barometer, and the barometer is telling us the pressure in the system has not been released. So what exactly is that reading warning us about? A soaring gold price is comfortable for the people who own gold and unsettling for everyone who has to think about what it implies. Because gold is the anti-dollar,
A gold price setting records week after week is by definition the world losing a little faith in the dollar-based system week after week. The chart that makes investors smile is a chart of eroding confidence.
Consider what the buying reveals about the buyers.
When the US Federal Reserve, the ECB, and the world's largest economies all issue the currencies people are fleeing, and the fleeing shows up as record gold, that is the issuer's own peers hedging against them. Central banks are, in effect, buying insurance against the paper their neighbors print. It is the financial equivalent of firefighters quietly buying flood insurance on the station.
None of this requires a collapse to matter. The dollar is not going to disappear, and gold is not going to become currency again. But a world where the safest reserve asset is increasingly a metal that yields nothing is a world signaling that it no longer fully trusts the alternatives. That distrust has costs. It can make debt harder to finance, currencies more volatile, and the next crisis harder to paper over than the last.
There is also a warning about the buying itself. Rallies driven by fear can overshoot, and a price lifted partly by momentum can fall as fast as it rose if the fear eases. Gold is not a guaranteed refuge. It pays nothing. It can drop sharply, and buying at a record high has burned investors before. What happens if real rates rise again, or geopolitical tension cools? The same two levers that lifted the price could reverse it. But the deeper signal is harder to unwind, because it is not about the next month's price. It is about a 50-year drift being reversed. The guardians of the world's money edging back toward the one asset that predates every currency they manage. That is not a trade. That is a verdict on the era of paper money, and it is still being written.
Return to where we started, an ounce of metal that more than doubled while nothing about the metal changed.
By now, the reason should be clear. Gold did not get more valuable. The world got less certain about the dollar, about the safety of reserves, about whether the promises printed on paper money will hold. And gold, the oldest money there is, became the place that uncertainty went to hide.
The rally is the sum of 100 quiet decisions. A Polish central banker vaulting metal against the war next door. A Chinese household moving savings out of a system it cannot fully trust. A Western investor watching rates fall and buying the one asset a government cannot print. None of them are panicking. All of them are hedging the same bet, that the age of unquestioned paper money is not as permanent as it seemed. That is the uncomfortable insight beneath the price. For half a century, the world ran an experiment, money backed by nothing but confidence, issued by institutions we agreed to trust. For most of that time, the experiment worked. What the gold price is registering now is the first serious, sustained doubt about it. Not a rejection, but a hedge, taken out by the very people who run the system. Whether that doubt fades or deepens will shape far more than the gold market. It will shape how governments finance their debts, how currencies hold their value, and whether the dollar's long reign continues quietly or begins to fray. The next time you see gold hit a new record, read it not as a headline about a metal, but as a reading on a gauge, one that measures how much the world still believes in its own money. If this way of reading the financial world is one you want more of, follow the channel. It is what makes the next investigation possible. Share it with someone who still thinks gold is just jewelry, and drop a comment with the system you want us to follow the money through next. Because the most important stories in finance are rarely about the thing everyone is watching. They're about what that thing is quietly measuring. And gold, right now, is measuring something the world would rather not say out loud.